Hi, everyone. Thank you so much for joining us today. My name is Sokha Yous, and I'm a financial wellness counselor here at Mayo Employees Federal Credit Union. Thanks for staying from the last presentation, and thanks for joining us online or later if you're looking at this later. Today's topic, we're going to talk about managing credit wisely. And also, if you have any questions throughout the presentation, please put it, just type it online or ask in person. Or if you're a little shy right now and you want to ask later for, more personal questions, you can always contact me. This is my contact information, my phone number, and my email address. So this will be at the end of the presentation as well. If you don't have anything to write down my information with right now, you can always go to mayocreditunion.org to get my information on the financial education tab of it. So again, today's topic, managing credit wisely. On the agenda, we're going to talk about the importance of building, the importance of a credit score, how credit scores work, what is in your credit score, tips to build a strong credit profile or how to improve your credit score, fundamentals of borrowing and what we have available here at the credit union, and then we're going to go over some fun little credit facts and myths. Play along and see how many of that you have right. So right now we're going to talk about the importance of credit scores, the role they play in your financial lives. So as we know how important credit scores are, so one, it's your ability to obtain a loan, whether you're in the market now or in a few years to get a mortgage, a car loan, or any sort of personal loan, anything like that that involves pulling up your credit. You understand that, having the best credit score possible will give you the lowest possible interest rate. So that's always better for you. The lower the interest rate, the more money that's in your pocket, right? So. And our credit scores are used not just to determine we can get a loan or not. It can determine whether you can rent somewhere. Oops, excuse me. It can determine whether you can rent, at the apartment that you're looking at, or if you can co-sign for someone to help them rent for their location. But also, a lot of people don't know that your car insurance rates are based on your credit scores as well. So first things first, of course, they look at your driving history. If you have good driving history, but your credit score is not the best, then your premium's based off of that, of your credit score as well, and also your driving history. And also some employers take a look at your credit scores as well. So it's really important that you make sure that you log onto your credit report, make sure everything is current on your credit report and correct. And if there's any fraudulent information on there, you can get that corrected as soon as possible, just to make sure that everything on your credit report is correct for your employer to take a look at as well. And then the next thing, so credit scores. There are statistical tools used to predict your future behavior based on your past, your history with it. There are three major credit bureaus. Each one has their own scoring model. We have Equifax, Experian, and TransUnion. So it's also important to understand that credit scores have funny way of telling time. To a credit score, 1 to 2 years is a short amount of time, and in the real world, we know that 1 to 2 years is not a short time at all. So, but to build credit score, 2 to 3 years on your credit report is actually really, really short. I like to describe credit as a marathon. Your credit score is a statistical tool, and in order for that tool to function properly and to provide us with meaningful information, there needs to be a lot of data. So another way to look at this is, if someone is going to predict how you'll act, who you think that will make the most accurate prediction, the person you just met or the person that you've known for years and years. So credit score is like that too. They take a look at your past history. The longer you've known someone, the more you trust them. Just like with credit scores, the longer your credit history, the more that they trust you. So that goes towards your scoring model as well. So what is in my credit score? So your credit score consists of a few things. So first things first, your payment history. So 35% of your payment history determines your credit score. With this being said, we want you to make your payments on time always, right? But if not always, then of course as best as possible. So your credit history, 35% of your, 35% of your credit score is based on your payment history. And then 30% of your credit score is based on the amount owed or credit utilization. So this tells you just how much control or willpower you have over your spending, right? So if you have $10,000 credit line and you spend all $10,000 right away, you'll look like a risk to them. You'll look like a risk to creditors. So it'll lower your credit score because then you've maxed out your credit utilization. We prefer that you stay preferably 30% and under, because that shows that you will have the ability to pay it back as soon as possible, if not all of it right away. And it also shows that you have that willpower to not use all the available credit to you, and that you're more of, you're thinking about the future. You're not just overly spending right then and there too. 10% of your credit score is your new credit. So it's really, so I'm going to tie that into the length of credit history. So when you get new credit, it really shortens the lifetime of your credit history, which then, going back to the last couple of slides, the shorter your credit history, the lower your credit score is. So we want to keep your credit history as the average age of your credit history as long as possible. And the length of credit history takes about 15% of that. 10% is your credit mix, okay? So ideally we want someone with a mortgage, a home, a car loan, a personal loan, credit cards, student loans. That's a good mix, but if you don't have that, then don't go out to get those loans. Just to have a good credit mix, just make sure you focus on your payment history. So tips to build a strong credit profile. Credit profile is very specific to you. So know your credit score, know how your credit score is calculated, and make thoughtful and deliberate choices. We want you to monitor your credit score report at least once a year. You can go to annualcreditreport.com or call that phone number to obtain your free credit report. So when you log onto that website, they're going to give you the option to look at all 3 credit bureaus. So you can take a look at Experian, review that, just to make sure everything is correct on there. And then you log on to, and then you move on to the next one, say Equifax, and then on to TransUnion. Now this is, this website, they're going to ask you for some personal information just to verify your identity. But this website is legit. I mean, they have a lot of security behind it. So it's really important that you review this at least once a year. During the pandemic, there was a lot of fraud, so they were opening up to people once every 7 days. You can pull your credit report just to make sure everything is accurate. Okay, so of course, payment history, we talk about how important that is. We want you to pay your bills on time. Remember, this takes up 35% of your credit score. Pay your bills on time, and if you've missed the payments, get current and stay current for as long as possible. So for example, if you're trying to get a loan with us, and we saw that 4 months ago that you missed a credit card payment, so we want you to have at least 6 months, preferably to a year, of current on-time payment history. And if you can't afford to pay your bills on time, please contact your creditors. So I was in collections for 16 years prior to taking up this position, and I really appreciate it when I talk to people who are having a hard time paying back their bills, that they reach out to us right away. They say, you know what, I'm going through a financial hardship right now. My full intention was to pay this bill, but I can't pay this entire bill. Can we do some sort of payment arrangement? So it's really important that you reach out to your creditors, let them know exactly what's going on. So they, just in case they have some sort of hardship program out there for you, or you can also ask for a deferment where you ask for this month's payment to be put on the end of the lifetime of your loan. So, but just remember, if you do a deferment, then the interest will still continue for that month too. So don't wait until it's too late to contact them early. You don't want to let them know what's going on when you're already 31 or 32 days past due, because then it's already been reported to your credit bureaus, or that's when it's, things get reported. New credit, because remember that takes up 10% of your credit score. New credit, you want to limit credit inquiries. You want to apply for and open new credit cards only as needed. This is really tempting around the holidays when they have a lot of good sale, and they, these stores want you to open up their credit cards so that way you can get extra discounts and things like that. It's so tempting, but just remember, do you really need this, credit card? Do you really, are you disciplined enough to not overspend on your credit card? Do you have the ability to pay it back? So just be very careful when you're being marketed towards opening a new credit card with different merchants. Have credit cards, but manage them wisely or responsibly, meaning paying them back on time, not overspending it. Close an old account doesn't make it go away, so just make sure that everything is paid off. If you close an old account but there's still a balance on there, just make sure that that's paid off. Make sure there's no annual fees that's still going on there. Make sure that nothing recurring is going on that credit card, just in case it makes an extra charge and you've already closed it, thinking that that everything is just going to be closed out. And Danny, just make sure you get a closing letter from that creditor too. So capacity or credit utilization, remember that takes up 30% of your credit score. So pay down high balance credit cards and revolving debt. So you want to pay it down as quickly as possible, preferably the entire balance each month. But if not, then at least just take it down to 30%. Okay, so just make sure that you don't try not to go over 30% because it really shows your discipline with how you spend money. So it makes other institutions trust you a little bit more too. You want to pay off debt rather than moving it around. So you want to go ahead and, if you have this credit card that's due, the entire balance that's due, you want to go ahead and pay for that one instead of just doing balance transfer to a different card as well. But also use caution with closing older credit cards because remember, when it goes back to that length of credit history that takes up 15% of your credit score, we want you to have the length of your credit history to be as long as possible. When you close your oldest credit card or oldest credit line, remember that really shortens the average length of your credit history. So just be mindful of that too. And length of credit history is the age of the oldest account and average age of all your accounts combined. So it gives you the average age. Do not apply for unnecessary credit accounts. Again, when you get a new credit card, then you have this brand new one, so it really shortens the lifetime of your credit history or the average age of your credit history. Use caution when opening new credit cards to do balance transfer. So if you have, let's say, a high, interest rate credit card, let's say from Capital One, and Discover is offering you, 0% introductory rate for the first 12 months if you do a balance transfer, then I think that might be a good idea for you to do that transfer. But just remember, how did you get in credit card debt in the first place? Did you overspending? Did you not just keep track of your spending? So just make sure that your routine with your money, your relationship with money is healthy, and that now that you have this available credit that has zero balance on there, are you going to be tempted to spend it again, to overspend it? Because if you're one of those people that will just overspend on credit cards because sometimes it doesn't feel like real money, just be mindful that, that might give you a better offer to do that balance transfer. But if you haven't really resolved your relationship with money, if you have unhealthy relationship with money, you're going to overspend again. So then now you're going to have to now you're looking at 2 credit cards with balances on it. So just be mindful, just be realistic with yourself to see how your relationship with money is, But if you're having a hard time with that, I think that'd be a good time to come see me or someone that can help you get out of this situation and help you, maybe call you out on some, a few things that you weren't aware of yourself. Did you go through a manic phase where you overspend to make yourself feel better? So it's really important that you maybe at that point try to get a second opinion from someone else to see if that is the best thing for you to do. The fundamentals of borrowing. So what impacts your credit score the most? What impacts your credit the most, excuse me? Your credit scores, of course, it impacts it the most. That's one of the first things we look at. Your credit cards, they have impacts on your borrowing. If you have a lot of credit card debt, then we're going to be a little worried to lend to you because of that liability. Look into it, excuse me. So loans with auto, home, and personal loans. We'll talk more about that too, and debt management. So when you try to get a loan with us or any other institutions online, anywhere else, of course, when you try to get a loan, they're going to take a look at your credit score and how much of loans you owe on there. So if you have a brand new auto loan, but then you're trying to get a mortgage too, that might affect your probability of getting that mortgage. So you might not be qualified for a mortgage right away, maybe wait a year or two. But if you have a lot of debt, that's, deter a lot of institutions from lending you money as well. Also, if you have a lot of credit inquiries, it's going to show that maybe you're shopping around for loans, but also show that you're just trying to trying to get as much loans approved as much as possible, so that might not be good on your credit score too. So remember, if you do a hard pull on your credit inquiries, then it lowers your credit score by a few points for a few months. It'll go back up, but it's really important that when you apply for new loans, you just understand, or new loans or credit cards, anything that involves your social security number that you're trying to, get loans or get some extra money out of, just remember that it is a hard pull on your credit report and that it affects your credit score. And also your payment history. So if we see that you have, a spotty payment history, we want you to have at least 6 to 12 months on-time credit history before we really consider giving you a loan. And also, we look at your debt to income ratio. So typically, we want something that is 40% or under. So how much you're bringing in is your income. So and then how much of your debt that you're paying is considered your debt to income ratio. That's how we determine that. So we want your debt to income ratio to be 40% or under. So now we'll talk about good debt versus bad debt. As we get into debt management, let's identify a difference between good debt versus bad debt. So good debt typically has a lower interest rate, something you believe will grow in value over time and help you increase your credit history and also help your future as well. So for example, like mortgage, you consider a good debt. Typically you get equity back. And if you, right now, mortgage rates are not the best, but if you are one of those lucky people that got your house in 2020, 2021, or even 2022, your mortgage rate is typically really, really low. So that's considered, your mortgage is typically considered good debt. Education, for the most part, that's good debt because it's going towards your future. It's going towards bettering yourself to help you get, higher, better employment. So that way you make more money. So it's more of investment into your future, into yourself as well. So with business loans, so typically some business loans it can be considered good debt and bad debt. So if you took out a loan to start a business that are a little risky, say a restaurant is a risky business to get into the first year or two, I think they said that a lot of restaurants fail. So that might not be a good debt to get into. But if you know that the business is, going to take off right away and make money off of it, of course, then it'll be considered good debt. Investments. So typically investments, let's say the S&P, it's been really good the last couple years or last few years. So typical returns, excuse me, are within, I think, 10%. But if you're getting a loan to do any sort of investments, things like that, if it's a bad market and your interest rate on your loan is higher than what the market is bringing in, then really you're losing money. So it's not really good debt to get into. Vehicle loans, a lot of vehicles depreciate, so but it's necessary. We offer really competitive rates here at the credit union, so it's really important to talk to one of our loan officers about whether you're going to be a good fit with, whether our loans will be a good fit with your lifestyle and where your credit path is at right now. So with vehicle loans, typically it's good because you need the vehicle loan. People that has vehicle loan typically need it, but you don't want to overspend. You don't want to go overboard. If you're just starting out, you're making $20 an hour, and you're looking at $100,000 Range Rover, that's not a good debt. That's something that you need to really reconsider your priorities and also your income. And really take a look at your financial goals and see if that is, if you want to spend that much money or if you can spend that much money towards vehicles. Credit card debts, if you typically have a higher credit interest rates. So credit card debts is always something that you want to strive to get out of as quickly as possible. I know that there are points and perks out there with credit cards, but the payoff is not, is not that great in it. So just might as well, you don't want to get too caught up in those points and perks and coming, that you're getting back after you spend, $10,000 or $20,000, something like that. So it's always best to just have, all your credit cards paid off and just have more in emergency savings or more in high yield savings account. So I prefer that you do that to pay off your credit card. Store credit, it's not always the best investment. It's not always good debt. So I consider those bad debt. Typically, the merchant accounts have much, much higher interest rate. With like the Kohl's credit cards and stuff, I think it's like 29%, 27, 29%. Again, depends on your credit score, but typically merchant accounts have much higher interest rate. So it's always best to kind of steer away from them too. Cash advance is always bad. It's not, there's no realm in here. I mean, there's just no reality where cash advance is a good idea because those cash advance places, I believe that they are illegal in like 15 states right now in the U.S. because their interest rates are so high. And typically once you get into one cash advance situation, you're going to get another cash advance to try to pay off your first cash advance. So then it's just really, really difficult for a lot of people to get out of. If you find yourself in a situation where you're about to get a cash advance, please reach out to us and see if there is something here that we can do to help you. Typically, with cash advance, when people are in this situation, they are in kind of a desperate situation to try to get cash as quickly as possible. But might not be the best route that is never the best route for people to go down. So just reach out to your financial institution or reach out to me as financial wellness counselor and see if there are other things that we can explore to help you out before you commit yourself to cash advance. So with debt management, so we want to organize your debt. A lot of times when I talk to people, when I meet with people and they want to pay off their debt, they say, you know what, I think I have this much, but then, when we pull up their credit score, or excuse me, when we pull up their credit report, they realize, oh my gosh, I totally forgot about this $20,000 debt that I have. You'd be surprised how many people say that, whether it's $1,000 debt that they forgot about or a $20,000 debt they forgot about. But first things you want to do when you want to manage your debt is organize it. Know how much you owe, who you owe, what the interest rate is, and what your monthly payments are. So the best thing to do is to go to annualcreditreport.com and pull up your credit report. So again, it's free. It doesn't affect your credit score at all to pull up your information. And you want to organize that. You want to prioritize and plan which one to pay off first. Typically, I want people to pay off something that has the highest interest rate first because that grows the fastest. And to get out of debt, of course, don't accrue new debt, right? So we want you to, unless it's try to get like a debt consolidation loan, then you can consolidate all your debt together and get under that one loan and just pay off that one payment. But before you look into that, please talk to someone to get a second opinion first, to try to just take a look at your debt together with you so they can help you determine what is the best route for your situation. We want you to budget, of course. Budget sounds a lot easier than said to some people, but again, make it as basic as possible. Budgeting means keeping track of your expenses. Where is all your money going to? And then you can determine how much of your income will go towards whatever, go towards whatever life. So it could be 20 or 30% of your income goes towards your necessary expenses, or it could be 50% of your income that goes toward your necessary expenses. So budgeting is what I help with a lot of people too. So there are presentations coming up on budgeting alone. So please keep an eye out for that. Or if you need help budgeting, please let me know too, and then we can work together. Things to consider when using a loan to pay off debt. So you want to consider an interest rate. So if you have, let's say, an average credit card debt of 8%, or let's say 12%, but now that you're trying to get a loan to pay off your credit card debt, but the loans that you're getting are quoting at 15 or 18%, that might not be a good idea for you to get that loan to consolidate your debt, because if your interest rate on your credit cards are lower than the loan, then you might as well just work towards paying those credit cards individually versus getting a loan to pay that off in lump sum, because that loan is giving you a higher interest rate. So determine the length of time you'll save. So will it take you 5 years to pay off your credit card, or is it going to take you only 3 years to get to pay off your loan if you decide to do a debt consolidation loan? Do you need to refinance your home or your vehicle to pay this off, to pay off your credit cards, or will that loan help you refinance your home or your vehicle as well to pay all that off? And then credit card balance transfer is the last thing you want to is another thing you want to look into also. If your the interest rate on your credit cards are high right now, and someone is offering you a 0% for the next 15, 17, 18 months, and you know for sure that you can pay that off, and you know that you're disciplined enough to not accrue new debt on your old credit cards, then that might be a good idea for you to look into. Again, please get a second opinion before you do that transfer, before you do anything like that. Now we can look into myth and facts. So just let me know, how much of this you agree with, or how much you don't agree with it, and let me know why too, or just play along. So myth number one, if you can't afford your payment, call your lender or creditor, and doing so will protect your credit rating. That's a myth. So earlier I told you if you can't afford to make your payments, then give them a call. Let them know what's going on so that way they can help you in the situation you're in. But that doesn't mean that because by reaching out to them, by them moving your payments around, that doesn't mean it's going to protect your credit rating, because maybe they only allow you to pay, they'll be nice enough to say, you know what, you can go ahead and pay half your car payment this coming up payment, and then you can do the other half on your next paycheck 2 weeks from today. But they have to report to the credit bureaus also that your payment is late or that it's not paid in full. So if they have to report that accurately every month, so they might still have to report that it's delinquent. So that's going to affect your credit score and your credit profile that you have a delinquent payment on file. So yes, we want you to call them, just make sure that you can move your payments around, but that doesn't mean that they're gonna not report it to the credit bureaus. But that's something for you to discuss with them too. If I can only pay half right now, are you gonna go ahead and report it that it's delinquent, or is that considered on time? What is you guys' protocol? So the next question, opening up a store credit card will save you money on what you buy and build your credit. So both, yeah. So for example, with Kohl's, they offer you 30% off if you apply for their credit cards. So that can save you money instantly, and it can help you build your credit if you're disciplined enough to pay everything back on time, or keep your utilization under 30%. So it could be both. So if I close my credit card, even if it's a card I don't use, my credit score will drop. Again, this is a partial fact. So this goes back to talking about the length of your credit history. If you close out an old credit card, that's one of your oldest one, then that really shortens the average age of your credit history. So it will drop because of your credit history being shorter now. So that's a partial fact. The next one, requesting my own credit report hurts my score. That's the myth. You can go to annualcreditreport.com, request to get your credit report, and that won't affect your score. But also, there's a lot of other credit card companies. If you have Capital One, Discover, any one of those major credit cards, even your checking account, will probably give you your credit score as well. You can actually go to Credit Karma, that's, gives you your credit score, but they're not really accurate credit score, but it kind of give you an idea where you're sitting at. So requesting your own credit report does not hurt your credit score. The next one, a good way to find out if my credit score is improving is to test out by applying for a credit card. That's a partial fact. So you can apply for a credit card. If you get denied, then you know that your credit score is not where it needs to be. But also, I feel like if you've been working on your credit score for a while, for a couple of years, the only way you'll know if you can qualify for that loan or for that credit card, see how much is improved, is to actually applying for it. So with that said, don't go applying for 10 or 20 credit cards at a time. Just, if you think you need a loan within the next couple months, apply for it and see what they say, what your credit score is actually sitting at, and see if you qualify for that. Not having any credit history is really bad. That's actually a myth. So having no credit history is better than having bad credit history. So it's really important that you know that wherever you're starting at, whether it's bad or no credit history, having no credit history is not that bad. So you can always build it back up. Or you can always build it up, or if you do have bad credit history, you can always build it back up too. I heard your credit score if one credit card is maxed out, but all your other credit cards are not. So that's a fact. So if you have, let's say, 3 credit cards, right? So one is Capital One, Discover, and American Express. But if you max out on your Capital One and your Discover One is at 50%, American Express can actually lower, it's not just American Express, but it can be any credit cards that's seen your behavior. They can actually lower your available credit or even close out your account because of all those other credit cards being maxed out or getting overspent, because they don't want to be, they're seeing you as a liability now, and they don't want to be the next victim. So they're protecting themselves by closing out your account or lowering your available credit as well. So that's a fact. If I pay off my credit card every month, I'll have good credits. It's a fact, unless it's something that if you're just paying your credit card and then you're neglecting other bills, and those other bills like your car loan, your mortgage, if those are behind, then that can affect your credit score as well. So yes, paying your credit card off every month is very important if you have the ability to do that. But if you're not current and on your other credit lines that are getting reported, then it might not be a good idea to pay the entire balance off and just save some extra money to pay off your mortgage and car loan as well. Is it better to settle an old debt for less than the full balance to pay than the full balance versus paying the full amount? So there's like settle in full versus paid in full. So it's both. So what's really good about this is if you have a credit card and it goes into, let's say, collections, like a first-party collections is still within the company, but you don't have interest rate accruing on it anymore, and you want to go ahead and settle it, then that'd be a good idea for you to do that. Just make sure that you take a look at what the tax implications are on that. But also, coming from an institution, when we see you settle a lot of debt, a lot of older debt, a lot of debt that have been closed or charged off, it's telling us that you do have this history of not paying your debt back. and then waiting for it to go into charge-off mode so that way your interest is not accruing anymore, and then you're paying that off as a settlement. So it's telling us that you're more of a liability. But if it's just one debt, two debt that you're doing that on, then it won't be looked at as a liability from the institution's point of view. I've bruised my credit in the past by filing a dispute. Will filing a dispute remove the bruise and improve my credit? Just because, that's a myth. Just because you file a dispute, that doesn't mean that it's going to remove it altogether. It might be a bruise because it's, it's an accurate bruise. If we have to report things accurately, so if you're telling us that, you are disputing us reporting your payment late, that doesn't mean that we have to remove it off your credit report. It just means that we will keep it on there because we reported accurately that you were delinquent. So just because you dispute it doesn't mean that improves your credit. That doesn't mean that it gets removed. But it gets removed if it's a legitimate, fraudulent bill, or if it's something that you have proof that you paid it on time, then yeah, we will update that information. But just because you dispute it, that doesn't mean that it gets removed. A credit repair company can remove collections and late payments from your credit report. That's a myth. So you can actually do that yourself instead of paying a credit card company or a credit company to do that too. But if they will remove, they don't have more power than you do as a consumer. So the only way that they can remove something off, like late payments or collections off of your credit report, if it's legitimate. So again, if you have proof that your payments were on time, then of course the creditor will update that and say, you know what, we'll remove this because you have proof that you made that payment on time and it was a mistake on our end. Or if you have accounts that go into collections and wasn't supposed to be, and it showed that you paid it off prior to the account going to collections, then of course that collection accounts will be removed because it wasn't supposed to be there in the first place. That's if you have proof that you paid everything on time with the first party, with the original party. So these credit repair companies, just be very careful with them. A lot of times, a lot of them are fraudsters. So just take a second look, have someone else take a look at it with you, get a second opinion, or reach out to me and see if it is a legitimate company. Once you have bad credit, you will always have bad credit. Obviously, that's the myth, right? Because you can always rebuild your credit back up. And I have had major disruption in my credit history, such as bankruptcy, foreclosure, and repossession. I should open a credit card to build my credit score. That's a fact. The fastest way to build up your credit score is with a credit card, unless you haven't learned from your lesson yet. What got you there in the first place? Was it your behavior? Was it a medical issue that made you fall behind on all your payments? Or did you overspend and you haven't learned from your lessons yet? So just be really mindful and just be careful, and how, just do some assessment on yourself. How did you get there in the first place? My credit score can change daily. That is a fact, because your different credit reporting companies report on different days. And then different creditors report it on different days too. So it can get updated daily as well. So yes, it can change daily. And we'll go ahead and wrap that up. If you have any questions, again, my name is Sokha Yous. I'm a financial wellness counselor here at Mayo Employees Federal Credit Union. You can reach out to me by phone or by email. Do we have any questions online? No? Okay, wonderful. Well, thank you so much for attending. Yes.
You talked about polls. If you are offered 30% off if you open a credit card on your purchase today, is that offer you no longer use that credit card? Is that for your score?
So the question is, in the example of Kohl's, if you open up a credit card with them and it gives you 30% off, and you pay it off right away and you don't use it again, will that hurt your score? Was that your question? Okay, so yes and no. So if you have, remember it's new credit, and so when you get new credit, it shortens the length of your credit history, so it can kind of lower your credit score for a while too. But also, if you don't use it ever again, just remember that you have an annual fee that gets tagged on there. And if you yourself telling yourself, you know what, I already paid this off, I don't want anything to do with them anymore, but you haven't closed it yet, but there's an annual fee tagged on there. Next thing you know, that annual fee is now accruing interest rate and things like that. But if you get that 30% off right away and then you close it out, after you pay off the entire balance and not use it again, it might still affect your credit for maybe a few months after that because of it's shortened the length of the lifetime of your credit history. So just be mindful about that. Is it really that much? Are you saving 30% off $100, or are you saving 30% off of $40,000? So just think about it that way too. So any other questions? Yeah, no? All right, good deal. But thank you everyone for joining us today.